Hey everyone, it's Olivia, and welcome back to the channel. If you've been watching the stock market this week, you probably saw one ad tech giant take a massive hit. The Trade Desk, a company many investors loved, saw its stock crash nearly 30% in one day. This wasn't just a small dip, it was their second huge drop this year, and possibly their worst single-day percentage fall ever. What happened? And does this mean the golden run for ad tech is over? Let's break it down. First off, Trade Desk reported its second quarter earnings, and on the surface, the numbers looked pretty good. They pulled in about $694 million in revenue, which was a 19% increase from last year. Their adjusted earnings per share were right where analysis expected them to be, at 41 cents. So good numbers, right? Not so fast. The stock market had priced in a much stronger recovery, especially after the company recently joined the prestigious S&P 500 index. Investors were looking for explosive growth, and what they got was a noticeable slowdown. That 19% revenue growth was down from 25% in the first quarter and 26% from a year ago. This slowing growth, coupled with their outlook for the next quarter, really spooked investors. Their forecast for the third quarter was around $717 million in revenue, which, while still growth, signaled continued pressures on the digital advertising market. Then there was the surprise announcement. Their longtime chief financial officer, Laura Schenkein, is stepping down. While they quickly named a new CFO, Alex Kayal, an unexpected leadership change, especially in a top financial role, often rattles investors and adds to uncertainty. When you combine slowing growth, a less-than-stellar forecast, and a CFO exit, it creates a perfect storm for a stock to tumble. So why is this happening? The digital advertising world is getting incredibly competitive. Trade Desk operates what's called a demand-side platform, which helps advertisers buy ad space. But big players like TikTok, Meta's Facebook and Instagram, and giants like Google and Amazon are all vying for those advertising dollars. Advertisers, facing economic uncertainty and concerns about things like tariffs, are tightening their belts and often favoring these larger platforms. Trade Desk's CEO, Jeff Green, argues that his company isn't directly competing with these walled gardens like Amazon or Google. He says Trade Desk helps advertisers buy across the open internet, like streaming TV and premium content, without bias. He believes that more ad spend will eventually shift to this open internet because of better engagement and objectivity. However, analysts are questioning if Amazon's growing presence, especially in connected TV advertising with Prime Video, is becoming a more significant competitive threat than Trade Desk is letting on. The company mainly serves large global brands, and these are precisely the businesses feeling the crunch from tariffs and other macroeconomic pressures, which directly impacts Trade Desk's ad spending. Adding to the concern is Trade Desk's stock valuation. Even after the big drop, the stock is considered very expensive compared to the broader market. For example, its share price is still about 13 times its sales, while the average for the S&P 500 is only 3 times. Its share price is roughly 76 times its earnings compared to the S&P 500's average of 23 times. This means investors were paying a huge premium for its rapid growth, and now that the growth is slowing, they're quickly reassessing if that premium is still justified. But it's not all bad news. Trade Desk still has some strong cards to play. Their AI-powered platform called Kokai is seeing huge adoption, with about 3/4 of client spending now flowing through it. And the results are impressive. Clients using Kokai are seeing about 24% lower cost per conversion and 20% lower cost per acquisition. The company expects all clients to be using Kokai by the end of this year, which could drive future performance gains. They continue to prioritize transparency and efficiency in the ad supply chain with initiatives like OpenPath and Deal Desk, aiming to make it easier and more effective for advertisers and publishers to work together. Another major strength is their incredible client loyalty, with over 95% customer retention for more than a decade. This indicates that once clients are on the platform, they tend to stay. The CEO, Jeff Green, remains very optimistic about the future, especially looking into 2026. He believes the long-term opportunity for advertising on the open internet is enormous, and that AI will be a game changer that favors independent platforms like Trade Desk. While the stock has seen significant declines during past market downturns, it has historically recovered fully. This suggests that despite being sensitive to economic shifts, the company has shown resilience over time. Analysts point out that if Trade Desk can deliver on its next quarter's guidance, investor trust could be rebuilt. Many still believe in the company's strong fundamentals and operational performance, anticipating significant gains for long-term investors with a 3 to 5 year outlook. So, while the Trade Desk just had a really tough week, the message from Wall Street is clear. Show us growth, not just potential. The company has to prove that its innovations and long-term vision can translate into accelerating revenue. It's a complex situation, but for investors, it might present an interesting opportunity if you believe in the long game. All right, that's our breakdown for today. If you found this information helpful, please give this video a big thumbs up, subscribe to the channel for more financial insights, and hit that notification bell so you don't miss our next update. Thanks for watching, and I'll see you in the next one.